Hello traders, Gary Wagner here, just before 10:30 in Honolulu, 4:30 in New York. It is Thursday, 7th day of June 2016, and this is the Daily Report for Gold and Silver. We have moderately lower pricing in the precious metals markets. Some profit taking is occurring as this market has been on a rampage and a runaway rally, having tremendous gains. This doesn't surprise me at all, but what it does affect is what we're going to do with our current position, which we're long at 1338. Our current stop's at around 1340. And with the jobs report coming out tomorrow, I believe that the most prudent move at this point is to either highly protect ourselves by raising that stop up tight or simply pulling profits. We'll talk about both strategies on today's daily report. Gold currently trading off about $6 on the day, 1360.80 with a low of 1352 and a high of 1372. And it is that high that is critically important because that was our first benchmark as we looked at the relationship between the first rally, what we're labeling as wave one, and this rally. And so 71 gives us a 1-to-1 ratio between the waves. That's why it's our first benchmark, and you'll see that as we pull up this first chart of today's daily report. So traders, this is what I am talking about, and that is the fact that this most recent rally really began when this market traded to an intraday low of roughly 1200. 1199 was the actual low. It was my sense that that concluded a wave two, and we were now in a wave three. Now, in order to basically put together a model, what we do is we use wave one as our benchmark. And what we say is that wave one, in terms of the impulse waves, is going to really determine what kind of retracements we're looking for in wave two, the percentage of retracements. It's also going to guide us in terms of a model of a wave three. Simply put, wave three cannot be the shortest of any of the impulse waves. So what we look for is at minimum a 1-to-1 relationship between wave one and wave three. That to us is the minimal amount that the market can actually trade to. Now, here's what I am actually looking at. I have simply created a single trend line right here, and that trend line starts at the onset of wave three to the conclusion of the first rally, this being a 1. And then what we want to do is fix our starting point on this to the conclusion of wave two, which is right here. So what we do is we fix it to the low of that candle, and then that's going to give us a 1-to-1 relationship. Now, there's another way to do that, and simply put, that's by creating a fib extension, which is exactly what we've done. But I just wanted to really show you how this scaled. Let me go ahead and pull this over now. But I just wanted to show you how that actually scaled. So here's what we're looking at. We came in, we completed wave two, we started an impulse wave. This impulse wave three is going to be composed of a 5 count, 1, 2, 3, 4, and 5. We believe that we have seen the conclusion of this wave one. We have absolutely seen the conclusion of this wave two. Wave two was almost a 61% retracement. I believe it came out to a 50% retracement. Now we're set into a wave three. Now, wave three cannot be shorter than a 1-to-1. So our minimum was 1371. Typically, though, on a strong rally, you'll get anywhere between 1.23 and a really extended rally will go up to about 1.61, which puts us at 1445. Now, that's not to say that the market won't go there, but with the jobs report coming out tomorrow, and the first kind of sense of that report is it should be or could be a bullish report because a precursor report came out with a better than expected added jobs, up around, I believe, 13,000 additional jobs than were expected. 177,000 new jobs were added. If that's the case, we could see some pressure come into gold, more profit taking. We could see the equities markets really ramp up and trade higher on the day. And then that's the fundamental news. Now, in terms of the technical news, take a look at this. We came up to this particular area, and we have absolutely found a little bit of profit taking or resistance. That doesn't mean that what we're witnessing is a reversal. In other words, a top and then coming back down. However, at the same time, we have to be cognizant of the fact that this is a logical place where we could see the market come down, and that would give us something like this: 1, 2, 3, 4, and then our fifth wave would take us either to 1.23 or to 1.61, these being the collective prices. My benchmark, or my area that I thought the market should go to, is roughly 1,400. However, we do have some decent profits, and I'm looking at it this way. We can just simply go ahead and pull profits at this point. Market's trading roughly at 63 right now. This is our daily chart, so it's not updating. We can pull profits here, 63, 64, got in at 38 and pull a nice profit out of the market, or we can go ahead and tighten the stops. However, the only place any kind of a real stop makes sense is going to be at maximum, really 52, meaning the low of the day. And so you're in at 38. If you do get stopped out, you get stopped out at 52. Now, my recommendation in terms of which of these two strategies you might want to implement, I would look at it this way. If you've been following our trades, especially all of the trades this year, you're up about 300% minimum. You're doing very well. So even if it came down and stopped you out at 52, you're going to take a profit from 38, and it's not going to be as big of a profit as the market trading at 63. However, if you've entered the service recently and maybe only have one trade under your belt or no trades under your belt with us, it might be most prudent just to, so to speak, take the money and run, because there is at least a 50 to 60% probability that we'll see some sort of profit taking, whether it's later on tonight in the evening session or tomorrow after the jobs report comes out. That being said, my sense is you're left with two choices. Either A, move your stop up to 1352, or B, simply take profits at the market. Market's currently trading at 63. Which one you'll pick will depend upon your adversity for risk, because whenever you're going into a report, there's an increased risk, but we're kind of protecting that by moving the stop up, or whether you're looking for a bigger payout, or you're comfortable with the profits here because we're in at 38. If you're out at 64, you've made a decent profit on the trade. I'm going to leave that up to you, but as I said, both strategies will get you out with profits. We don't know what the future will bring, so act accordingly on the one that makes sense to you. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow after the jobs report, in which we will have the weekly wrap-up and review. Bye-bye.